What up, everybody? Oh, I got to turn this up now. I had to turn it down on the last one because I think they were saying that it was a little too loud. Let me know if this is okay for you all. I still have it turned down just a little bit. I'm in the process of shooting a response over to United about one of our flights. So just give me one more second so I can finish this and then we will kick off. I want to talk about creating a game plan for 2025, specifically for newer traders, but this will apply to just about anybody that is looking to trade this year. So that's the goal. So give me 2 more minutes, and then I think we should be ready to kick off. So I'll reset this timer really quick so that you guys will have a clear time to expect me, and then I'll be right back. All right. Thank you all for hanging out for just a few minutes. Let me finish that up because this has been an ongoing battle. We are ready to talk about options trading for beginners. This is the basics. Now, with the new year, I typically kick off a new segment, which I'm still going to do. I was originally going to plan on doing a series with a couple people like I've done previously, but I was looking through my schedule and I honestly just don't think I'm going to be able to give it the attention that I would want to. So what I'm going to do is build a syllabus for us. And I want to work through similar to what we did for the first series. But what we'll do is go through a recap of kind of the options 101 stuff. And then I'm going to start moving us into options 201 stuff. Now, while I won't be able to do the committed series like I have previously, where I have a few people that I meet with literally every single week for at least an hour, sometimes two, go through their trade plans, trade logs, it's very time intensive. And it's something I take very seriously because I want to do a good job. But I won't be able to do that because I already have people in the mentoring program that I need to make sure I have time for that, and so on and so forth. So what I'm going to do is still try to bring people into the series directly, but it just won't be as direct of a structure like I've been able to previously. So I'm going to work on the syllabus. And one of the things that I intend to integrate into this upcoming series is quizzes and things that you can take home. So there will be quizzes that we're going to do together during the streams and talk about the answers and stuff like that. But then there will also be quizzes that I'm going to give you ahead of time. The reason for this is it allows us to be more efficient during the stream rather than me having to read through the question and then people kind of coming up with it on the spot. I want to develop the quizzes ahead of time so that you can answer them and then I can literally just review them on the stream for you. So there will be more information that comes out around this whole thing as we get closer, but giving you a heads up on the direction that it looks like this is going to take and what you can expect as we move forward and get closer. All right, so let me get to the main screen. We're actually going to start with this. Now, the purpose of this series remains the same. And what I want to talk about is the need to invest and why this needs to happen. You've seen this before in different degrees, so I'm not going to spend a lot of time going over it and talking to you about it. I think you all can probably see pretty well what this is and what it generally represents. So the punchline is you need to invest. Everybody needs to invest. Whether you choose to actively trade or simply passively invest, all of that is a choose your own adventure. And it's whatever you want it to be, and it's whatever's most efficient for you, whatever fits best for you. Now, the whole purpose of trading is we look to accelerate some of the outcome of investing. And it means that we try to perform better than the market typically, so that rather than earning the average of somewhere between 10 and 12% per year annualized, you can hopefully double or double plus that. Now, my return for last year, I've already told you it landed at 92.22. And that now takes this should be 17 years. That was my 18th full year of trading. My bad. 18 years of trading. Damn, that's kind of nuts, isn't it? That's crazy. Sorry, I just another year crept up on it. That's crazy. So 18th full year of trading. So that takes my compound annual growth rate over the 18 years to 31.6%. That is primarily skewed from the last 2 years. So if I update this really quick to give you what it would be sub those 2 years, it would be 20.35%. That's getting rid of the 118% return from last year and then the 92% from this year. If I change those really fast, 118 from the primary, and it was a little bit over that. It was like 172%, which was a significant change. But the overall return, I track it as 118, which is the primary output from general trading activities. If I change both of those to 15% out of curiosity, that would take my compound annual growth rate to 22.5%. So these last 2 years have single-handedly skewed my entire compound annual growth rate trading performance. Now, the reason why that matters is I want to give you a couple examples. And if we go to the website, which hopefully you all are enjoying the tools that are on here. And if we go to the compound interest calculator and we take a look at somebody that's starting with $25,000, let's say that they're saving $2,000 per month. And let's say that they're looking at this for a 20-year time span. If they have a benchmark return, and let's say the S&P 500, instead of being 8%, this is a little bit dated. Let's say the S&P 500 is like 11%. And then let's say that you actually return 20% on average. The difference here is massive, right? So if we compare to the benchmark return over this time frame, the benchmark would have returned you 1.7 million. The 20% that you might be able to return would pull you at 5.4 million. So you double and change what the S&P 500 would give you. This is what trading is about. This is exactly why we do what we do. The entire purpose behind this is to permit, for me, more reliable and steady growth based on application of a skill set. Now, there's nothing wrong with that $1.7 million that you might earn in SPY. And then once you get rid of taxes and stuff like that, it's a great return, but significantly less than what you can make being even a solid trader, not a perfect trader, not the best trader, a solid trader. And that's what this is, right? That's why I use 20%. You'll find traders all the time that outperform this. And I always will bring that to your attention because the pool of potential is very, very deep. So if we take a look, this doesn't look like it's updated, but it'll still serve the purpose. Yeah, this is only through 30 Nov. They don't have through Dece yet. So this is looking at the US Investing Championship. And let's take a look at the returns here. So this is 11-month returns. So we can see for Money Manager, the reason why Money Manager is really, really important is because money managers have different imperatives that they have to follow. And it looks like Jay Law and Judy Lai, which these people look like they work at the same spot, 308%, 230%. Arian Candlewall, 144%, so on and so forth. Enhanced growth, meaning that we can use derivatives, 105, 62, 48. You'll find this to be the case actually pretty regularly, which is always interesting to me, that when people have derivatives included, that they tend to do worse than equities. And I just find that fascinating. Then the actual stock division, $20,000 accounts, I honestly don't care that much about because it's much easier to scale a very small account like this. But you can see that there's somebody literally with almost 1,000% return, right? Crazy. Then if we go down to the derivative side of things, still for very small accounts, 20K, 610. So then if we typically, hold on, where's the rest of this? There's another, this is bullshit. So for those that don't know, there's another bucket. I don't know why it's split like this, but there's a million plus bucket that's not here for some reason. And I don't know why it's not here, but that there's typically another group. Now, and it's not the money managers, to be clear. The money managers are different than just million plus accounts, but larger accounts are more difficult to scale. What I'm just showing you is what's possible. This is what's possible. Now, my planning factor here is literally 20%, right? So take that in the context of what I was just showing you is possible. And that's why I use this as what's possible, because it's genuinely possible and attainable by people. Now, that leads us into this, the title of the live stream, which is creating a game plan for 2025. When you're trying to accomplish something, you have to have a target to shoot at. If you do not have a distinct target that you're shooting at, then you tend to hit all over the place, kind of randomness, right? And this is from a shooting perspective. You likely will have heard this before if you shoot, but aim small, miss small. And I've used this example before because it's a really, really great example. And I'll show you what I mean. If we grab just a shooting target, just grab something completely random. And let's say that you're shooting at this BMOD target or whatever these other silhouette targets are. Sorry, not BMOD, silhouette. If your goal is literally just to hit somewhere inside the body, your grouping is probably going to be terrible. You'll probably get something over here, something over here, something over here, all over the place. The concept of aim small, miss small is I'm going to not just aim for this X, I'm going to aim for the intersection of the X and pick a needle point that I'm trying to drive a needle through that's at the dead center of the intersection of that. The whole point of that is to remain very, very focused on the exact spot you want the rounds to go. Now, taking this back into the world of trading, you have to decide what you're shooting for. What is the target that you are trying to hit? Exceedingly, exceedingly important. Because if your goal is just to trade and see what happens, guess what is probably going to happen to you? You're probably going to get results that align with just trading and just seeing what happens. That's not ideal. This is why I think it's really, really effective to try and determine some sort of return potential for yourself. Now, you've also heard me say this before, and I genuinely believe newer traders don't get to pick what their return is going to be. The reason why newer traders don't get to pick is because newer traders don't even know what they're capable of producing yet. So if you don't know what you're capable of producing, you picking something doesn't make any sense. So a lot of what I'm talking about here is from the perspective of slightly more seasoned traders that have a little bit of a track record that they can lean on and use as a planning factor. If you are a new trader, my position for that cohort is a little bit different. And I believe newer traders should focus way more on a fundamental level of first, be profitable. Make greater than $0. I genuinely believe that is likely the target that will keep you from blowing yourself up until you're at a point that you can scale it, which is a thing. You will be able to scale it at some point. But right in the beginning, it's very difficult to scale something based on a skill set that you don't really know whether or not you have. So one of the biggest issues newer traders will face is they'll say, I want X% return. And that's fine and dandy. The problem with just randomly saying, I want X% return is you may or may not be able to achieve it. So if you focus first on simply trying to be profitable for your first couple years, seeing what the skill set looks like, seeing what you're capable of producing, then you're in a much better spot to come up with an informed decision. Dan says, I used to watch this other YouTuber who swore by taking profit as soon as it hits 10%, which doesn't make any sense. Like I would easily pick apart that framework. It doesn't make any sense. But that's just for one trade rather than a cumulative total for a period of time. Yeah, that doesn't make any sense whatsoever. So the problem with coming up with arbitrary targets like that is it's completely insensitive to the expected return for the strategy. So picking an arbitrary thing of 10% is just that. It's completely arbitrary. And you run into the problem of the system itself that's quintessential disposition effect, where if you'll remember standard disposition effect, it's where we have a profit that we take down too fast for whatever reason. A lot of times it's because we want to realize a gain. We like the process of realizing a gain. So yeah, I would argue that is not logical. That's just not a solid route to take. Again, there's a way that taking small profits can work. I'm not crashing out and saying small profits never make sense or anything like that. I'm just saying picking a defined something like that doesn't really make sense. And Reese says you'll never land in APP like that. That's literally an exact point. So for those that don't know, what Reese is referring to is a position that I put on in APP a while ago. Hey, it looks like it's actually setting up again. But I entered in here and I wrote it all the way up through here, scaled down a little bit, added more here, and then I ultimately scaled out here. And then I think I flattened out the rest of the position a few days into it. So that's based on a specific strategy, though. That's not to argue that this is the only way to trade. It's not. This is one approach that I take in a book of many. So to give you an initial starting point, I want to show you the covered strangles that I'm going to be running this year. And I did a little bit of homework today on what I think I want to do. And I want to walk you through the homework so that you have context. Again, that's one of the things that I try to equip you with is the approach on how to do things for yourself. So there are two covered strangle strategies that I want to talk about. One of them is in T triple Qs, and then one of them is in UPRO. And I want to talk about some of the math behind the way that we can set these up. And then for Roaring Titty, the way that you fix that is you go into studies. I'm literally going to make a video about this because people ask about it all the time. You go into volume profile, and then you turn off expansion area. So expansion area needs to be turned off, and then it'll overlay it here. Then you have to go down here to globals, and you can change the colors of the zone itself. I get rid of a lot of the noise. I get rid of the value areas and stuff like that because I don't really care. None of that matters to me. But that is a quick version on how to fix that. So then next, if we take a look at this, I want to show you something. We'll do it in here. This is fine. So let's say that we have $100,000. I don't know why it just moved me to here. Not do that. We have $100,000 that we're going to use. And let's say that we have a couple choices. The first choice is we could put it into SPY, we could put it into SSO, or we could put it into UPRO. This is 1x, this is 2x, this is 3x. Daily returns. Very important point, daily return. So the first thing I want you to think about is if we were using this $100,000 in this example, and we want to assess the return performance for all of these. Let's actually, well, that doesn't matter. We can do it from a theoretical sense. I was going to grab the actual returns for 24, but it doesn't actually matter that much. So if we want to have $100,000 working in all of these positions, how much money do I have to put up in each of these positions to have $100,000 working? Well, in this one, I need $100,000. In this one, I need $50,000. This one, I need what? 33,333 repeating, something like that. What I'm showing you is you can, I guess you just set it up like this so it reuses the format. What do you notice here in this setup? If I want to maintain $100,000 of exposure, and I want to maintain $100,000 of total exposure in something like the S&P 500. I have three tickers I can do it with. I can do it with SPY, SSO, UPRO. There's like SPXL. There's others you can use, but these are, this one specifically is way more liquid. So if I want to maintain $100,000 of exposure, then in SPY, I have to use all of it. In SSO, I have to use half of it. In UPRO, I have to use a third of it. So the interesting part is that if you don't apply an overly greedy approach to maintaining the exposure that you want, when you use leveraged tickers like this, you can use less of your money upfront, which then gives you way more flexibility as the underlying moves. So, say for example, we got SPY when it was $100. Let's just say all of these are $100. And we wanted to use all of the money, right, to maintain the correct exposure. Well, in this scenario, we use all of our money, we buy it at $100. So that means as it moves around, it doesn't really matter that much because you're using all of your money. So if it goes down, you can't scale in because you've used the money. And if it goes up, that's great, but you're not really realizing any profit there unless you're selling calls against it. That's the main way you could realize profits in this scenario. So now, if we look at this in SSO and the underlying starts to go down, guess what we can do? We can scale in on the way down because we're using less money. We have $50,000 that we can then apply to the strategy as something goes down if we're not automatically defaulting to the same dollar amount up front. This is a way to use leveraged ETFs to reduce your risk. Reduce your risk. So what I mean by that is, let's say SPY goes down by 30% as a 30% drop. So in this case, we have this minus this times this, and we're going to lock this. So in this scenario, if we have a 30% decline in total, the dollar amount that you can lose will look very different depending on the actual decline, because these would also have 2 times the move here. So this becomes this. And then this becomes this. So you can see in this scenario, you're still losing way more money if you take something like this, straight punch to the face, and you hold it all the way down. You lose a lot more money. In this case, you only lose your 30K. In this, good. So you're using way more of your money, and the total amount that you can lose as a gross dollar amount will be very static. So the interesting part in terms of what you're actually losing, you're losing way more of the total amount of money you have out, right? So if we do this as a percentage, you're down 90% of your money here. If you do this as a percentage, you're down 60% of your money here. But as a total gross dollar amount, you're not really any worse off because we're sizing the position based on what it represents rather than the overall same dollar amount invested. So that is why I'm trading UPRO and TQQQs 3 times leverage, is because I'm maintaining the correct exposure that I want to mirror the current exposure if I were to hold the underlying itself. However, I'm simply using less of my money. I'm risking about the same total amount of money during a drawdown, but I put less of it up. So, and what that eventually allows me to do, let me grab this back, is as this starts to go down, I can then add to these to reduce the basis. Now, what's the danger here? as soon as I start to add to them, my total risk will go up. Whereas on this 30% down move, my SPY position will only lose $30,000, and that's what it would be at this 30%. If, let's say, it dropped 10% and I started sizing up the risk in these, then I can lose more than this amount of money. So you have to be prepared during the process of scaling and pay attention to what the path might look like for you. This goes back to, again, the entire point of the live stream today, which is to talk about creating a roadmap for 2025, what you're trying to do. And if that's not already defined, you have to define it. And this weekend, because guess what? The year's already started. We're already a couple trading days in. Your trading performance over the course of a year is going to be built on what you do on a daily basis, and you're 2 days in. So if you're trying to figure out what you want to do longer term, then now is the exact time to have that defined for the year. IR too bad. Ken says sounds like 9 sig sorta. Yeah, I don't know much about the 9 sig strategy, but from my understanding, it looks just like a leveraged ETF trend following approach. So yeah, because the thing that is really important, I think, when it comes to managing a strategy like this is overlaying it with Shannon's Demon, which we talked about actually on the live stream previously with something like with Peruvian Bull. And something like Shannon's Demon can help reduce overall volatility pretty massively through a rebalancing protocol. So what that means is as these eventually go up, what we would do is take some of the money out to trim our exposure back to what we want the exposure to be. And then we can scale it. So let's use non-even numbers now and do $200,000. So if you have $200,000 that you want to run into something like this, then you have to use all $200,000 up front for this. You're on a 30% drawdown, you expect to risk 60, but for SSO, you need to use 100K. UPro, you need to use 66K to maintain this $200,000 exposure. So then the scenario now is if, let's say, rather than going down, the market goes up. And I think I could just change this. Yeah, I need to change these to pluses really quick. Give me one sec. Plus. And then these need to be plus. So now, if the market starts to go up, depending on how much money and depending on the path that it eventually takes, what this is doing is applying the same amount of leverage, but you're using much less total money, So let's go back to the down move side of things first. And we say we have a 30% drawdown on your total capital. And it looks like this is fine for now. The main point I want to make here is as things start going up, and let's say we get a 15% up move, 15%. So in this case, you would make your $200,000 plus your $200,000 times 15%, give you 230. So then this would give you $100,000 plus this times 2 times $100,000. So what ends up happening is you can still, I actually messed up the syntax there, sorry. The point I'm trying to make is when you have it start going in your favor, you can rebalance to maintain the same dollar exposure that you actually want to keep. And if you maintain the correct dollar exposure for the underlying itself, then you can balance your risk, pull some of your risk off so that when we eventually get the down move, you're not actually risking any sort of significant premium over what the other account is. And then you can still maintain some of the upside potential depending on how you scale in and stuff. So it's one of the really cool things when it comes to leveraged ETFs. They can reduce risk, but they have to be used really, really responsibly. One of the main things that you get to benefit from and why they're so fantastic for something like the covered strangle is because a big part of the covered strangle is scaling protocols that would underperform the underlying itself unless you're in a sideways market, slightly downtrending market. Then the covered strangle would outperform. So in the aggregate, it would outperform because the market will show all of those different cards. But during the up moves, you would slightly underperform. And it's because you have capital that's not being utilized to maintain the exposure you want. So for part of my portfolio, I will continue to run the covered strangle in UPro and TQQs. I'm also running it, I'm running it in IBIT, and then I also started it with GameStop. So I have a handful of the covered strangles on right now, but that's the overall game plan currently. Stray J says, how are you dealing with option liquidity on SSO and UPro? Liquidity doesn't matter really that much. So I'm not trading SSO, and SSO is, I would argue, better for people that just want to be uninvolved, meaning you don't want to trade it that much, because the liquidity in SSO is entirely circumnavigable via something like the covered strangle because there's just not that many round trips that are associated. Whereas via UPro, definitely more liquid, and it allows slightly more active management to be applied without taking as much out via friction. But the covered strangle itself isn't really that high touch of strategy. That's the whole purpose of it. It's why I built the strategy the way I did, is because it's designed to give me market beta with a slightly enhanced return profile that's not high touch, that allows me to also realize gains as we move along. So I think in here, I show you the GameStop covered strangle. This is from the video yesterday. One of the things that I wanted to show you was this here, where GameStop itself is, I think it was up like 26% and 29% respectively when I first looked at this. So the difference here, though, is if we take a look at GameStop, even how the covered strangle is performing right now, one of the things that the position has, which, hold on, this is missing this. I was wondering what was wrong with this. This should be W. It's because I copied this over. 12,233. So one of the things that this has going in its favor, the covered strangle versus just holding the shares in GameStop on a comparative basis, is there's, oh, that's why. Hold on, I'm sorry. These are wrong. This should be 19. I have to get rid of the lock for when I copy and paste this over so it's not wrong. 41. The main difference here, though, is for the covered strangle. The covered strangle, as it's designed, doesn't rely just on unrealized gains. It also allows me to benefit from realized gains. If this number calls me back, I'm going to pick it up just because I have no idea who it is or what it is. or why they're continuing to call. So, primary difference. GameStop here, if you're holding the shares, you're doing well. You're up 30% over this comparative time frame, but all of that is unrealized gain. If you look at it from the covered strangle perspective, you have, albeit very small, but you do have a realized gain, which is great. Oh, this is finally from Air Canada. I'll call them back in a little bit. They've already pissed me off, so I'll deal with them in a little bit. So yeah, that's one of the really cool parts about the covered strangle as it sits and why it is a solid strategy for stuff like this. And it's why I use it, honestly, is part of my core holdings, because it's really, really dynamic and it's very simple to manage, which is super convenient. So the whole point of this tangent and going down this path is to try to give you some ideas as you're defining your goals and what you're trying to target for the year, some different ways and methodologies that you can do that. And one of them is by using something like this. I've talked about it a ton. I literally have an entire playlist built around the strategy itself. Go-to for me. It is a old, well, not really that old, but it is a absolute go-to strategy for me that I've run for some time. And I will very, very likely continue to keep running it because it benefits the overall portfolio in a really, really nice way. And it's easy to manage, like pretty significantly easy to manage. Sweet. So let's talk a little bit more now about creating targets and goals for the year. So for the new trader, we already talked about what I would consider to be the initial target that makes the most sense. And that initial target is simply setting up a greater than zero return, right? That's the initial target for a brand new trader. Now, the way that you achieve that is, again, if you just focus on make more than $0, who knows where you actually land? That's why I think for a small account, new account that's just starting, greater than zero baseline. And then above that, I would pick something that you're comfortable with. It doesn't have to be much. You could pick 5% return, 2% return, like something like that. And the reason why I think that's a important component to it is because you're giving yourself a distinct target to shoot at. But again, you have to remember one of the issues with building your return profile is that a lot of people, they just inherently get way too aggressive, meaning they want to have this really, really big return because that's what their mind wants to see at the end of the year. That's dangerous. That's really, really dangerous. And the reason why it's dangerous is because we start to, like, I've literally have had people ask during some of my mentoring sessions, they'll say something like, do you think this return is possible? And the first question I always say, well, the first part of that is, if you have to ask, you already know the answer. The second component to it is when I see the largest return targets, it's for people that have this grand plan on a roadmap where they're trying to land. And that's good and that's okay. The problem with it, though, is more often than not, when we start thinking about our lives, we start thinking about what we want to do, what kind of travel we want, what kind of house we want to buy, what kind of work we don't want to have to do anymore. We start to think like, okay, like, yeah, I need a little bit more money. I need a little bit more money. And then you're like, okay, well, I now need to have $5 million and I don't want to work for 30 years. I would love to be out in the next 10. So I'm going to use 10 years as my planning factor. My starting amount of capital is very small. I have $100,000. So how do I go from $100,000 to 5 million in 10 years? Right? Like you could see the problem built into this. And it's because we're crossing our desires with what's possible or rational. And you have to be rational in the way that you build this. Because I'm telling you, like, if you are not rational about it, you're purely going to set yourself up for failure. You're going to make this not achievable for you, which is unfortunate because there's no reason for it to be unachievable. But that's typically what ends up happening to people. So that's something to keep in mind. All right. All that aside, I wanted to just share some of those broad thoughts with you all, specifically for the newer traders kicking off the new year. Now, we have a little bit of time left. Happy to bullshit or answer any questions or anything that you may or may not want to talk about. And if you do have some stuff, great. If not, what I want to do is actually start building this syllabus. And the reason why I want to build this syllabus together for the Outlier Options Trading Bootcamp series is because I talk to you all about building your own syllabus. So it would be a chance to do that together. All right. Let me see. Lauren says, as Eric is about to go off on the airline, can you record that call and post the video? Yeah, this has been a battle that I'm going on for some time. Yeah, it's been super frustrating. Actually, this is them. I'm going to answer it. Hold on. Name of the game is be disagreeable. That's what it comes down to. So we just wrapped that up, and it looks like we have a beginning to a resolution, but we're not quite there yet. So let me get through the rest of the chat really quick and see what else we want to cover really fast before we wrap up. Let me see. Tommy says I picked a 6% return for 25, gives me a monthly target. Yeah. And I think, Tommy, for something like that, that's like a really good, beginner's target. That's not something I think is suitable for a longer term target, just because you obviously want to, as a more seasoned trader, you'll want to return more than that in case you need it. More or less, the broader return should be done in the context of either trying to drive top line returns or to reduce drawdowns, reduce portfolio volatility, something like that. Let me see. And it looks like, cool. Tommy says I'm a beginner trader. Yeah, good. Yeah, then I think that makes a lot of sense. That's good. I dig that. Perfect. Shrey says Thor busy looking through book for 2024. Thor is, I think he had his, yeah, he's not even in here anymore. Thor bounced. He was ready for his dinner. So before we wrap, then let's do this. I want to work on the syllabus with you guys, and I would like to build it with you. Okay, cool. So I already had it started. Roy Titty says, Eric, you should make some merch like flashcards. I don't know about no flashcards. If you want to make them for me, let me know. You can keep the money. Let's do here. This will be Outlier, options, trading, basics. This has to be an acronym. Outlier, options trading, bootcamp, syllabus. And here's how I intend to break it down. Let's do, I guess the first thing is how many episodes do we want to do? Because I think depending on that, it will change how many things go into this. So let's do a market recap. This would be things like exchanges, brokers, participants, securities, that kind of stuff. Then we would do a derivatives recap. So this is options, futures, purpose, and traits. Then we would do options. We will do options, history. Then we would do elements, or components, I should say. An option, settlement. We want to do Greeks, utility. I think that's most of the recap stuff. Then we would move into intermediate. This will be things like, oh, hold on. This is crazy. So the exact thing that I thought was going to happen is what's happening. They're pointing the finger. These people are crazy. All right. We'll let them stew on that for a moment. Now, for the intermediate stuff, we'll take a look at the big four, or no, the outlier strategy process, outlier trade process. We'll want to look at things like interaction between delta and gamma. We'll want to look at delta, gamma, theta, vega. And then we will want, what else would I consider intermediate? We'll look at technical analysis, fundamental analysis. We'll take a look at types of base strategies. So this will be things like trading volatility, correction, etc. And then we'll take a look at, I think it's probably decent to start, and then we can build on this as we go. Because I'm going to have some quizzes for us along the way, and then the quizzes are going to help us dial in what stuff like out of this that we want to spend more time on. Cool. So this will be what it starts to look like. We'll either start it next week or the week after, not fully determined just yet. So that wraps me up. My dinner got here, so I'm gonna go eat. If you guys need anything, let me know. Hit me up in the Discord. Be in Outlier. I'll see y'all later.